Stocks seem undeterred as of late, pushing higher despite lingering uncertainties from the Fed's June meeting to recession and the never-ending debt ceiling talks. Then there's the debate over the health of corporate America more widely. S&P 500 companies have delivered a healthy amount of beats, but accusations of corporate sandbagging or lowering expectations just to surpass them, that's also been a theme. That's a theme for a long time. Let's get back to Simeon Hyman, ProShares Global Investment Strategist. So it has been interesting. I mean, we've sort of been range bound for a while, but then recently did seem to have a little bit of breakout to the upside. I was looking at some of the stats from the October lows. A lot of it's been about tech. Industrials and materials have also done okay, but we've had this big upsurge. Is it a justified surge?
Well, we likely don't have too much room left. So I think from our perspective, what we've been thinking about is first you start with the bond market. And what we see in the bond market since the beginning of the banking thing, whatever we want to call the banking thing, we've had this rally in treasuries. Of note, it's all been a decline in inflation expectations. So that's good. That means that the contractionary banking thing is probably just enough to bring down inflation, but not a deep recession. What that means is that it does likely suggest that multiples are probably range bound. And if you scatter plot PE multiples against a 3.5 to 4% 10-year, you get 18 to 20. And we were at 18, we're at 19 now, so 20 would be 5-point-something% away in terms of multiple expansion, which then leaves it up to earnings, which, as we know, have been bleeding low single-digit declines for the S&P 500 for several quarters now.
And so with that in mind, in terms of the forecasts that have come through over the course of this earnings season, is there set to be any type of rebound from what we're expecting that would make valuations either attractive or make them kind of make them actually worth investors' attention right now?
Well, they're fairly valued. Again, 18 to 20 is an appropriate range. So if you're looking at earnings now, there isn't much of a sign that earnings growth is going to be any particularly better than what we've been seeing. Forecasted earnings growth 23 over 2022, consensus is flat. So if we're coming in -2, -3%, that's not too far off from flat. So you do have to think about where are there pockets in the market where there's some companies who are growing earnings. Tech is a maybe, but of course the valuations are rich. If you're looking for companies that are growing earnings that aren't that expensive, our ETF ticker NOBL, which we talk a lot about, tracks the S&P 500 dividend aristocrats. The PE is about 20% discount to the market, and for the last 3 quarters, they've been expanding margins and growing earnings because they're consistent dividend growers. So it's going to be a muted environment, I think, for the rest of the year.
So this is now leading me to look up how the Russell Value versus the Russell Growth has done. I mean, value has not, because when I think about dividend aristocrats, I think, and what the themes that you're talking about, I tend to think of value over growth. But as we know, growth has been outperforming. So as we get to that sort of top potential, if you will, of the S&P 500, do you think we'll start to see that shift back into value? Are we already seeing it?
Well, I think there's a challenge here. So first, if you look at the dividend growth stocks, they're really in the middle of the style box because that word growth is in there.
Right.
They're kind of garpy. And the challenge here is if you go to that value side and you're not getting enough growth of whatever it may be, earnings, cash flow, dividends, then if you buy a stock that's not growing anything, then you actually bought a bond. So that's what I think is the challenge on the value side of the equation.